Rob Berger, and I am glad to be back with you tonight. Hope everyone is doing well. Going to start off tonight talking about Jerome Powell, the Fed chair, his speech in Wyoming on Friday, and my thoughts on that and inflation and interest rates, and I guess the stock market. Appreciate a thumbs up if you guys can hear me and I guess see me. A couple of things before we jump into inflation. On Wednesday, I'm interviewing the CEO of Fundrise. So thanks, Marty, for the thumbs up. So if you have questions for Fundrise, shoot me an email and I'll do my best to incorporate them. I think that's actually the only thing I wanted to say ahead of time. Oh, no. One other thing. The channel just passed 5 million views. So that's great. Thank you. That's kind of exciting. I guess it's a big fat round number. I'm trying to get to 100,000 subscribers because then I think I get a plaque from YouTube. So I'll have that going for me. All right, so let's dive in. And then of course, after that, I'll get to your questions. Here's the speech he gave. You can actually find it on the Fed's website. Just Google Jerome Powell speech, Jackson Hole, which is where he gave the speech. And it's not very long, like the Gettysburg Address, short and to the point. But there's a lot going on in the what he said. In a short speech, there's a lot going on. And a lot of it, for me, kind of circles back to this book, 21st Century Monetary Policy, which I actually finished today. This has been Bernanke's book. And I found his walk through the sort of the history of the Fed, particularly from, I would say, 50s, 60s, maybe 60s for me, forward, was fascinating. And one of the things, so, Paul Volcker came in, I think he was appointed in 79. I think it was 79. And we all know what he did. He beat inflation into submission, but it was painful. We had stagflation, all that was going on. And I remember it, I'm old enough to remember it. I was like I was a kid, so I wasn't like, working. I wasn't a grown up. Some say I'm not now. Anyway, but I remember it. I remember the gas lines. I remember Ted Koppel every night, day 112. If you're old enough, you know what I'm talking about. But in any event, before Volcker was Arthur Burns. There was actually another person in between them for just a short period of time. But Arthur Burns was the Fed chair trying to deal with inflation. And there's sort of two really big lessons that came out of his failed attempt to get inflation under control. The first is households and businesses' expectations about inflation are really, really important. I've heard it referenced as the psychology of inflation, but what we think is going to happen, what we're expecting to happen, really matters. It can turn into a self-fulfilling prophecy. You expect prices to be going up at a fast clip, so you want a higher raise, and you're dissatisfied if you don't get it, and your employers give it to you, and then they have to raise prices to offset the costs. It can be a problem. And the second thing, and it's related, is that inflation can almost act like a possum. You think it's dead. You think the Fed does what it does, tightens, monetary policy, raises short-term rates. You think you got inflation under control. Like Miracle Max from The Princess Bride. It turns out it's only mostly dead. And so what happened under Burns was he would tighten. It looked like inflation was dead, but it turned out only to be mostly dead. So he then eased up, and there's political pressure to do that. This doesn't happen in a vacuum, and it springs back to life. So then he, tries to beat it into submission, thinks it's dead. No, it's not. Springs back to life. And what happens? Those two things: the fact that inflation keeps coming back, doesn't seem to quite want to die, and then it becomes entrenched in consumers and businesses that this is just the way things are. This is the way it's going to be. And they have this expectation of inflation. And in fact, he gave a speech after he was his time at the Fed ended. This would be 1979. He said, "Nowadays, businessmen, farmers, bankers, trade union leaders, factory workers, and housewives," gives you a sense of the time period, "generally proceed on the expectation that inflation will continue in the future. Whether economic activity is booming or receding, kind of doesn't really matter. Once such a psychology has become dominant in a country, the influence of a central bank error, letting up on restrictions because they think inflation's dead when it's only mostly dead, that intensifies inflation may stretch out over years. Okay, so that's the history lesson. Now let's dive into what Powell said. And, he first kind of talked about where things are. Inflation is here. We've had some big raises. He said here we had a second 75-point increase. And I said then that another unusually large increase could be appropriate at our next meeting. He's never going to commit ahead of time. They're always going to say something like, we're continuing to evaluate the data and all of that. In fact, he says here, our decision at the September meeting will depend on the totality of the incoming data. That's all normal Fed speak. At first, I had a little glimmer of hope with this right here. I'll make it a little bigger. I don't know how well you can see this. He said, at some point, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases. Okay, well, that doesn't sound too bad. But then he doesn't let you rest. Restoring price stability will likely require maintaining a restrictive policy stance for some time. And he talks a little bit about that. What I want to get to, he brings up the 70s and 80s. He says we've learned a lot from that time period, 3 things, but I want to focus on the second and the third. The second lesson is that, here we go, psychology. The public's expectation about future inflation can play an important role in setting the path of inflation over time. So it's the very lesson that Arthur Burns was talking about in his speech back in 1979. The one thing about a great Fed chair is they are phenomenal historians. They study how the Fed tools can affect the economy, how the economy behaves. I mean, he knows his history. So he talks about it here. One of the things I found fascinating, I'm not going to read all this to you. You can obviously read it, but he invokes the name of Paul Volcker. It's kind of like saying Voldemort, right? As former Chairman Volcker put it, at the height of the Great Inflation, which is what they called that period in 1979, inflation feeds in part on itself. So part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. And here, this is just my view. Feel free to disagree. I don't think he just is, let's just find a nice little quote to throw in his speech. What he's really saying, I think, is, I'm about to go all Paul Volcker on you. We're going to beat this thing. And we ain't going to let up just because we think it's mostly dead. We are going to kill inflation, and we're going to do whatever it takes. And if you want some sort of historical reference, go back to Paul Volcker's time as the Fed chair. I think that was very intentional. That's at least what I got out of it. All right. And he has some other interesting things here. And then he says, let's see, the third lesson, which is that we must keep at it until the job is done. This is the whole mostly dead thing. History shows that employment costs of bringing down inflation are likely to increase with delay. So this may not be easy and pretty, but if we wait, it's going to get worse as high inflation becomes more entrenched in wage and price setting. And then we mentioned Volcker again. The successful Volcker disinflation in the early 80s followed multiple failed attempts to lower inflation over the previous 15 years. Just what I was talking about with Arthur Burns and his speech. A lengthy period of very restrictive monetary policy was ultimately needed to stem the high inflation and start the process of getting inflation down to low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. So he ain't messing around. He doesn't want to have 15 years of failed attempts to deal with this. And he's going to keep at it till the job's done. That was my takeaway. And the market reacted, right? The market was down a couple of percent on Friday. I think it was down today too, right? I think it was down. Yeah, it was down. All right. There are a couple other things going on, though. The Fed certainly can control this to some extent, but it doesn't have complete control. And one of the challenges, so you talk about monetary policy, that's what the Fed's doing, setting interest rates and all that sort of thing. They don't, by the way, directly they really only control one directly. They can influence others by buying and selling like Treasuries and so forth. But they don't like go into the market and say, okay, this is what, will be the mortgage rate, interest rate on a mortgage. But in any event, that's monetary policy, what the Fed is doing. Fiscal policy is what Congress and the president are doing. And if you want to fight inflation from fiscal policy, one way to do it would be to increase taxes, but don't put those dollars back into the economy, like use them to pay down debt, for example. Well, that's about as popular as, I don't have a good reference right now, but it's not popular, right? Politicians don't like to do that, because that gets them voted out of office, right? And in fact, we had a huge stimulus because of COVID. We go back to 2008, we had some stimulus there, small by comparison, but still significant. And we're in some ways, we're still having more stimulus. I mean, the Inflation Reduction Act, kind of a comical name because it doesn't really seek to reduce inflation. And some could say it will increase inflation a little bit. I don't know that it's the studies so far suggest it's not huge, but I mean, everything matters. But that actually becomes a problem. You've got the Fed doing what it's doing. We're going to be, I guess we're in a recession now. I think it's likely at some point to get worse. Politicians don't like that because they want to get reelected. And, because, I mean, they care about their constituents who, can suffer a little bit. Now, this sounds all doom and gloom. I don't really mean it. I don't know that I feel that way per se, but I do think we're in for some challenging times as we deal with this. And the federal government could make it worse. I hope they don't. We'll see, it depends on what, spending bills get passed and, like even like forgiveness of student loans, which that's a whole nother policy issue. But there's going to be an effect that will affect inflation, right? I mean, again, there's debate about how much, maybe it's not significant, but all these things start to add up. So there was a paper, I can't actually find the paper, but I've read about it, that was presented in Jackson Hole, right, where they had this meeting. The authors were an academic and I think someone from one of maybe the Fed Bank of Chicago, maybe, that basically said, look, here's how I interpreted it. Mr. Powell, that's great. Appreciate you're working hard. Yeah, you're gonna go all Volcker on us, and you should, and you can do a lot of good. But half of this inflation ain't something the Fed can control. It's from fiscal policy and what people are doing in Congress and the president. And by the president, I don't mean the current president, but just the generic who's in office. And so there's only so much you can do. And unless we deal with the fiscal side, it's going to be a tough battle. And then on top of all of that, you have the impact on other countries from our raising interest rates. Because as our rates go up, it attracts dollars, as dollar gets stronger, and that can really hurt emerging markets, that often borrow not in their own currency, but in US dollars. And if that becomes more expensive, particularly over a prolonged period of time, bad things can happen. Have I changed anything that I'm doing in terms of my investments? No. But I am sort of mentally preparing, and then just wait and see. I don't know. We'll see what happens. People are predicting, well, this is when the market will crash, or gloom and doom, and I don't buy into. But I could see having a painful recession. I think unemployment will likely go up at some point in this process. We'll see how quickly they can bring down inflation. Again, the problem is it's just not monetary policy, fiscal policy, and then there's energy. What Russia does affects us. Just that's the life, that's the world we live in. So it's not as if the Fed, can just wave a magic wand and fix everything. They can't. Obviously, what they can do is very important, but that's it. So, yeah. All right. Have a nice day. Yeah. So it's sort of like, I think if you wanted to summarize what he was saying, it was buckle up, right? Put your seat back and your trade table in their upright and locked position. We're coming in for a landing. That's about how I describe it. Noreen points out that we just passed 62,000 subscribers. Yes. And Vinyl confirms that I do get a plaque. I'll show it to you when it comes in, if I ever get to 100,000. All right. Jeff, I'm thrilled that you made it on time tonight. Where are you? There he is. All right. Oh, and my mom says she loves me. Love you too, Mom. Keep saving your money. Could have a rough, couple of years. I don't know. Be frugal. All right. I used to steal quarters out of my mom's purse. She knows this, I think. Maybe she's forgotten, but I've told her. When I was a kid and sneak across the street to the 7-Eleven to play pinball. Loved pinball. I probably took, I don't know, 100 grand out of her purse in quarters. Probably wasn't that much, Mom. Okay. Marty is making a prediction. He thinks we'll be at 10 million views within 6 months. Oh, that seems like a tall order to me. So I don't know what, so the question is, what do you think of Peter Zeihan's, I'm guessing? I don't know who that is. Predictions based on demographics, reversing globalization, shrinking of China, etc. I'm not familiar. I was watching Rich Dad, Poor Dad, who I love that book actually, but I don't know what happened since then. And he had Harry Dent, who I thought was a character from Batman. I don't know, but apparently he's a predictor, and they were predicting gloom and doom. I don't really predict that. I mean, I do think if to fight this inflation, we're going to have a rough ride, but I don't kind of predict that our monetary system as we know it is coming to an end. But I don't know who this is, so I'm afraid I can't help you there. Demographics are interesting. I mean, that's real. I mean, for the United States, I just don't have a sense as to how that's going to affect things. Omar says, I'm about to get rid of my bonds for a combination of REITs and I guess foreign stocks. Can you talk me off the ledge? No. Can I talk you off the ledge? Well, I guess my first question would be why. Understand too that some people will look to certain kinds of investments as bond alternatives. REITs, utilities, they tend to have higher yields than say a typical S&P 500. But if you look at them from a risk perspective, at least if we're defining risk as volatility, then they're not really a bond alternative. The other thing is, I don't know where rates are going. Remember, just because the Fed raises the Fed funds rate doesn't necessarily mean that trickles through all of the interest rates. It certainly affects some pretty directly. But at the end of the day, like Treasury yields are a reflection of the market's view of inflation, right? And there's some that would say if the Fed is really hammering down on inflation, it actually makes people optimistic. Maybe not in the near term, but you get out a couple of years on the yield curve, and people think, yeah, inflation might not be so bad. And in fact, I'll show you one other thing. In this speech, he references the SEP, not a SEP IRA. The Summary of Economic Projections. This is something that the Fed releases. Let me see if I can quickly find the latest version of it. I'll show it to you. Oh, here it is. It's not a very fancy document. I'm very disappointed in their style. They really need to up their game. It's like 1980s called. They want their report back. But as I understand this document, it's basically the Federal Reserve Board members each have their own prediction of what's going to happen. And then this doesn't single anyone out, I don't believe, in terms of individual members' views. It just sort of aggregates them all together. And so, like, here's the change in real GDP, and here's the median, and they define these terms: central tendency, which I think takes out, what's it's footnoted. Yeah, excludes the 3 highest and 3 lowest projections, and they also have to show you the range. But in any event, for 22, 23, and 24, and then longer run, they do that. Here's the unemployment rate, which, by the way, I mean, if you look at this, I don't know how well you can see it, but it keeps it at really good numbers. The highest is 4.1. There's this concept of they call it U star, like the letter U and then an asterisk. U star is how it's pronounced, I believe, and it's sort of the natural rate of unemployment. At what point can we have an unemployment number, let's say it's 4%, where it doesn't run the economy so hot that we have inflation or too restrictive, what's sort of the natural, stable level of employment? And they do the same thing with interest rates. It's called R-star. And, so meaning at what interest rate are things kind of stable? We're not growing too fast or shrinking. But the problem is like, there's no simple answer to that question. No, there's not. It's not as if someone has the answer. And one of the problems is, according to Ben Bernanke's book anyway, in the 60s, 70s, was we got those numbers wrong. We thought we knew them. We thought we understood what I guess it would be U-star. Well, both of them. And in hindsight, we were wrong. But in any event, this is, I don't know why I get so excited about this stuff. It's like, I need to get a life. Anyway, that looks pretty good to me. Of course, this is just their perspectives. They could very well be wrong. Inflation, they see it coming down in 2024 to 2.2. So, and longer run 2.0. But again, it's interesting. They've got core PC is a tad higher. So I think that just like CPI, core CPI, I think it strips out food and energy. And in any event, you might check that. There's a lot more, by the way, here. I mean, I just looked at look, fancy charts. Boy, it doesn't get more fancy than that, does it? Yeah. Anyway, kind of funny, really. All kinds of data in there if you're interested. I don't typically read those. I looked at that just from reading Ben Bernanke's book, because he mentions it and some changes to it, and because of Jerome Powell's. I left the comment up there. Hope that didn't mess up you seeing that beautiful, well-formatted document. Okay. Yes, Noreen, thank you. Join the newsletter. I actually remember when gas was under $1 when we moved here to the Washington, D.C. area. And we moved here in 1992. And I can remember maybe for just a very, very short period of time getting it for 99 cents. Of course, as a kid, it was much cheaper. I mean, I can remember, my mom and I going across the street to the 7-Eleven and putting like, $2 or $3 in the gas tank. All right. You guys are all talking about all these memories of your hourly wage. Okay. This is a great question. Kenny wants to know if I know if the portion of B&D distributions that come from Treasury bonds is distributed state tax-free. I've got to believe that they are, but I don't believe I've ever owned B&D in a taxable account. I thought we looked at this the other week, actually. And we looked at this the other week. But that's okay. We'll look at it again. Here it is. If you own a bond mutual fund or ETF, you'll need to calculate the amount of income you earn from the fund's government bond holdings in order to take advantage of this exemption when you file your taxes. It won't be reflected on the tax forms issued by your investment company. This is from Vanguard. So there you go. Interesting. Well, okay. So Paul has a question about inflation. He understands that it's a monetary effect. My question is, they tried to cause inflation, and it took supply side shocks to cause it. Raise rates, lose jobs. Well, so first of all, I am not an economist at all. I did take micro and macroeconomics in college, for what that's worth. I forget all of it. I would not say it was a supply side shock that caused inflation. I think supply side, so if we think about demand, supply, and then demand, supply is a ship gets stuck in the canal and can't get through. So all of a sudden, the supply of trinkets that we buy at Walmart aren't there, or not as many are there. So it's a supply shock, right? So there's few, the demand hasn't changed. We still want to get our stuff from Walmart, but it's sitting on a ship stuck in the canal. And so there's less of it. So prices go up, right? That'd be supply side, right? But demand, there's been a demand as well, because the government showered us with money. So we had money to spend, and we spent it on stuff. So I've read a couple of studies on how much of it was supply, how much of it was demand, and there's probably no answer to that question. There's just opinions, but I think it's both, from at least from everything I've read. And so on the demand side, at least if it's caused by it's fiscal stimulus, not monetary. So again, I think monetary, I think Fed. It was from fiscal stimulus. There is, to your point though, and this actually, Bernanke talks about this in his book, is, we kept rates low for so long, and we were doing the QE1 and QE2 and QE3, and there wasn't inflation. What's going on? Weren't we just printing dollars? So his answer, as I understand it, first of all, just to be clear, the Fed doesn't print money. I was watching a YouTube video, a very popular channel. He kept saying the Fed's printing money. Now, the Fed is not printing money. Maybe it's just a technical, I don't know. It's just wrong to say that the Fed is printing money. They're not. Treasury, now they may be printing money. But what the Fed will do, this whole quantitative easing, what they did was, as an example, they could buy from the market, say, U.S. government bonds, Treasuries, right? So they're taking Treasuries out of the market and putting cash in. Well, where does that cash go? It's not like they go up in a helicopter and start shoving 20s out the side to everyone. And at least according to Bernanke, and I think he's a pretty knowledgeable source, it ends up in bank reserves is actually where it goes. So it could eventually make its way to Main Street through lending, for example, but it's not as if it's different than fiscal stimulus, right? With fiscal stimulus, you actually got a check in the mail. I'm looking around for a check. I have a check right here. You get a check, you got to go spend it. When the Fed does what it's doing, it's not passing out checks to people, and the money gets added to a bank's reserves. And I actually at one point knew a fair amount about the capital requirements of a bank, but I would have to go back to the 90s because I was doing litigation over, I was involved in cases involving failed savings and loans because of some government regulations that actually go all the way back to the 80s. But today, I don't know a thing about the capital requirements of a bank, but it gets added to the reserves, and then that can free them up to make more loans, but they're of course going to do that based on whatever underwriting standards they have. It's not as if it just goes to the bank and goes flying out the door. I don't know, Paul, if any of that answered your question or not. Well, and it'll be interesting to see what effect what the Fed has to do will have on unemployment. We saw what their projections are, but time will tell. You can have high interest rates and good employment, just like you can have high interest rates and a lot of, in fact, many argue that high interest rates and lower unemployment can go hand in hand in theory. Depends why the rates are going up, but in any event, time will tell. I don't have any answers. I just have opinions. Okay. I don't know what this involves. This question is from Ricardo. What are your thoughts on securities lending on a brokerage account as an extra income? I'm not sure what that looks like. It doesn't sound good to me, but I would need to know more. That's not something I've ever encountered. You're lending out what exactly, and to whom? Maybe I need to Google it. Okay. Now we're talking about Teslas. Lovely car. I've test driven all of them. I love them. Don't own one. I tried to order one. I think they said it would be ready in 2074. Yeah. Ridiculous. All right. I didn't know they did this. So G wants to know, what do you think of Morningstar replacing all comparison indices with their own proprietary indices? No transparency in holdings. I didn't realize they did that. Although I did know, I guess, maybe I did. Oh, I didn't know they replaced it, but now that I think about it, like if we go to a fund, let's go to, Dodge and Cox. That was a fund I owned a long time ago. VODGX. I don't own it now. It's an actively managed fund. It's been a very good one. It's relatively inexpensive for an actively managed fund, 51 basis points. I own this fund. I mean, it's probably goodness. It's been at least 20 years. But if you go to performance, you'll see these, and I think this is what G's talking about. Let me take the comment off the screen. Here we go. I think this is what he's talking about. You'll see things like this. So blue is the fund, right? Red is the index, but we don't know what index yet. And yellow is the category. And they define all of that usually. The category is large value. And this may be what you're talking about. The index is the Morningstar U.S. blah, 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 blah. Yeah, I don't know what that is. I mean, this means value. U.S. I don't know what LM. So, I mean, we could look this up. I'm not going to do it now. But yeah, that's not very meaningful to me. What I tend to do, and not that I spend a lot of time evaluating actively managed funds, but what I would do if I were if we were going to consider investing in this fund, let's take a look at the portfolio real quick. Here's what I would do. So this is clearly large value, right? So I might compare this fund to an index fund, right? We could compare it to let's see here. Let me pull up another fund. One of our fan favorites, Schwab U.S. Dividend Equity, right? Because that is a value fund. Let me see if I can show it on both screens. Okay, here we go. So Schwab's on the right, Dodge and Cox is on the left. And this one is much cheaper, 6 basis points, right? This is the kind of comparison I would do. I would compare this active fund, I don't know, to some number of index funds, low-cost funds that are trying to accomplish the same kind of, style. So if we go to portfolio, it's large cap value. Let's see right here. In fact, if we look at them, I mean, the blue dot, this is very technical. The blue dot is, almost spot on between the two of them. And then you'd see how much historical data you can get. I mean, one way to do this would be, I could compare them side by side in Morningstar, or we just go to PortfolioVisualizer and see how much data we've got. Let's do that. So here we are. So we'll do Dodge and Cox, which I think is DOGX, right? Yep. And we'll do the Schwab fund. This is the kind of thing. This is just as an example. Dodge and Cox has been around for a long time, so it should have plenty of data. And yeah, it goes back to 2012, and it's the Schwab that's the limiting factor. And look at that; they're both spot on, almost identical. Dodge and Cox a bit higher, but look at a lot more volatility. So anyway, that's the kind of thing I would do anyway. I don't know if any of that's helpful. Okay. By the way, eventually Morningstar, you're not going to be able to use their portfolio tracking without being a paid, subscriber. So I think for most people, I was not. They're an advertiser actually. I don't know the last time I actually made any money from Morningstar, but even as an advertiser, I don't think most people need it. You've got 3 or 4 or 5 funds, or you've got 10. I mean, eventually, you know what they are. What are you analyzing in great detail? And you can always just look up the funds for free on Morningstar. I like their tools. I'm not so sure their new version of them. It still needs a lot of work. But yeah, eventually, I think you're going to have to pay, and I probably just wouldn't do that. Okay. What is this? Thorin says, I'm at level 3 financial freedom, which is a reference to my book. I had levels of financial freedom. So level 3, I think, is 1 year of expenses saved, I think, if my memory serves. But must confess that I used colorful language with my boss last week. I'm not even sure what's going on there. But I think you're being serious because then we have a follow-up comment. I guess it depends on what the colorful language was. You know, people talk about FU money. I know J.L. Collins, that's his big thing. I really dislike that a lot. It's not, by the way, you know, you should never say a curse word because trust me, one of my nightmares is that I'm live streaming and don't realize it. I think the stream is over and I've decided to play a game of speed chess and I lose. And you guys hear some of the things I say when I lose. And Mom, if you're listening, sorry, it's just, you know, no one's perfect. Okay. All right. Matt, thank you. Appreciate it. You know, they do have blunt tools. This was a comment from North. Too bad the Fed only has blunt tools to deal with inflation. Those tools hurt employment and the economy. And that's true, can be true. I mean, they always talk about the soft landing. So we'll see. I mean, that's obviously what they're trying to accomplish. I think Greenspan and Bernanke kind of accomplished that-ish at times. Well, what they're going to do, as I understand it, in terms of selling off the Fed's balance sheet, that means getting rid of all of the treasuries. Now, they're not going to literally get rid of all of them, right? They need some as necessary to affect their policies, their monetary policies going forward. But my understanding, they're not actually going to sell them. They're just going to let them mature. Now, they ended up buying some long dated treasuries, so I don't know. Maybe they could keep them on the balance sheet, but they're not taking, once they mature, they're not buying new ones. At least that's my understanding. Okay. So Matt, there's two responses. He wants to know, will the S&P drop to 3,750, 3,500, 3,250? So there's two things here. One, there's no way to know. Don't listen to people who tell you that answer that question because they don't know. And the answer shouldn't, in my view, shouldn't affect how you invest. Crispin 38, opinion on SLYV. Well, have we looked at this before? I'm going to start taking notes of, well, that's not it, of what funds you guys asked me about. SLYV. So that in future, oh, this is the S&P 600 small cap value. I'm going to make a note of this in my note-taking app, which I'm doing now. And I'll deal with the details later because I'm going to start looking these up in my note-taking app to see if I've talked about them in the past. We actually have looked at this. Here it is. You know, this is your basic, you know, it's, small cap value fund, relatively inexpensive. Small cap, as index funds go, small cap can be more expensive, but it's still 15 basis points. This one's probably may not be, oh no, it's really small. So here's the way I think about these funds. What asset class is it covering? It's covering U.S. small cap value, right? Okay. Is it inexpensive? In my view, yes, 15 basis points, index fund. I would want to make sure that it's got plenty of volume because it's an ETF, but this is going to have plenty of volume, at least for the kind of money I think most of us are investing, you know, not an issue. And then at that point, to me, it's a fund that I would group with other funds that to me would be very acceptable in a portfolio where you want small cap value. Wouldn't be the only one to consider, but I think it would be a reasonable choice. And that's how I think about it. So Mitch Bennett, my good friend Mitch, welcome to the show. I think you're a longtime listener, first time commenter, I think. Anyway, Mitch is a friend of mine. For many years, we worked out together. Now, I haven't been in a while. By the way, Mitch, I hope you're trying to get them to do the team training, because I will be back. Anyway, is not the cause of inflation directly related to government spending? I know politics is not the point of the show, but $5 trillion added additional spending over the last 2 years beyond the annual budget will likely cause the price increases. No question. Yeah. And that was sort of the point of that paper that I alluded to, that study that was presented at Jackson Hole, that fiscal, stimulus has absolutely contributed to it, but it's not the only thing, right? If you think about like oil, right? Cost of oil, Russia's craziness in Ukraine as an example. And of course, that affects a lot more than just what we pay at the pump. That's another example. It's not, unlike other areas of inflation, it tends to go up and down depending on what's going on. But that, absolutely can cause inflation. And over time, eventually, all of the monetary easing that was done, particularly during COVID, but even before then, can over time eventually cause inflation. One thing that Bernanke said, that I mentioned U-star and R-star. It is the view, I think, that the natural rate of interest rates and unemployment are today lower than they used to be. And he talked about different reasons why that may be. Again, there's no answer, but I do think that can explain why we went so long without seeing inflation. There could be demographics at play. I know someone mentioned demographics, but yeah, absolutely. I couldn't agree more, Mitch. There's no question that it's not government. It doesn't necessarily, in my mind, government spending per se. A big part of it is basically I'll call it free. I don't mean that in a derogatory way, but the money that they just pushed out directly to people. Yeah, it was unprecedented. I couldn't agree more. No question. I don't know, Jay, I'm not sure where you're watching this show, but I can assure you there are more than 10 people watching. There are 391 at the moment, which is about right for the show. The show fluctuates. By the end of the week, it'll be viewed about 10,000 times. A lot of people don't watch on Monday night. Okay. Here we go. From Jeff. VTMFX for a taxable brokerage account, or is it okay if I remain in VWIAX? I've never had a brokerage account before. Does it make a difference if I'm in the 12% bracket? Well, let's first see what these two funds are. Vanguard, right? So this is the Vanguard tax managed balanced Admiral shares. And what's the other one? VWIAX. We've seen that one, right? That's Wellesley. So the first question I would have, and I don't honestly know the answer, it's a question that I'll ask you. I'm not sure, given your tax bracket, how important it is to be in a tax managed account, and whether that tax managed account, because of whatever they do to manage it, might have slightly less performance. So this is, I don't even know what this is. I mean, it's large cap, sort of blend-ish / growth. What are they investing in? Oh, wait a minute. Let's go back up. Oh, this is, okay. So this is like Wellesley. Well, this one's Wellesley, which is, isn't this like 65-35? No. Oh, that's Wellington, I guess. So this is 60% fixed income. Well, really more than that. You add in cash, only 35%. I always get Wellesley and Wellington confused. So, because the first thing I look at in picking these two funds is the asset allocation. To me, that's like step one. And I don't know what asset allocation you want or you think you need, but they're notably different, right? This has, we'll call it 58 plus 3, 61%. I don't know what the non-classified is in fixed income, and this one has 50. So it's a 10% swing. So that's the sort of the first thing, is figuring out what asset allocation is best for you. In terms of so that's the first thing. And the second thing is, normally I would try to avoid a balanced fund like this in a taxable account. Now, given your 12% tax bracket, it may not be as significant. Of course, there's state income tax. I don't know where you live, but it may not be as significant. That's something you'll have to decide for yourself and maybe with your tax preparer. But what you can do, and I've shown this before, but we'll look at it again. Go to performance, and you can get this information directly from Vanguard. Go to distributions, and you'll see what their distributions were. So if we look at the last full year, 2021, no cap gains, which would be in blue, income of 59 cents. That in and of itself doesn't tell you anything. You need to look at the net asset value of the fund. So if we do that, it was, you can see it here at the end of last year, $42, 42.50. So, it was whatever that is, 12, 13%. Not 12 or 13%, sorry. 1.2, 1.3. I got to get my decimals in the right spot. Percent. So that's not at all terrible. But again, to the extent that this is interest income from the bonds rather than dividends from the stocks, although, that's the other thing. Like, depending on your tax rate, you might have 0%. Well, no, you wouldn't. Well, you might. So you have to understand that not all income is treated the same, right? So I guess what I've given you maybe some things to think about. There's no way I can quote unquote answer that question, though. At least in my mind, I can't. Those are sort of the things I'd be thinking about. And then I'd talk to an accountant or your tax preparer. Okay. Greg, welcome. Greg is tuning in from his vacation. Wow. You're a diehard. What's this about, Neil? What happened? I didn't hear this. I'll have to look at it. Yeah, I see some articles. I'll have to read that. All right. I was in cash for 3 years and went 50% energy materials, 50% treasuries. Yeah, okay, you're just taking on more risk, but again, by that I just mean volatility. So Canyon Overlook says, I assume you can open multiple no penalty CDs at Sallie Mae, like 5,000 and another. Yes, you can. So this is, I think he's referring to Save Better, which we've talked about in the past. They're an advertiser. Sallie Mae's 270, and that's for a no penalty CD. I think that's the best no penalty CD, and as that I've seen, and as a result, probably one of the best CDs generally. But before you go off and invest in that, I think you need to take a hard look at short-term, Treasury bills, like maybe around the 6-month mark. I bought some more, and I'm going to be buying some more, and I'll show you the. I'll show you the interest rates. Maybe, yeah. So right now, Yeah, the 6-month right here's got a yield of 327. So that's what, 57 basis points above what that no penalty CD is offering. That doesn't, in theory, one could work out better than the other depending on what rates do. Obviously for the CD, it's locked in and you can take it anytime you want or leave it there for whatever that was. I think 14 months. Yeah, 14 months. Obviously, if rates go up or go down, it'll affect the value of this Treasury bill while you own it. But of course, you're only owning it for 6 months. I suppose if interest rates just bottomed out, went way down, this only lasts for 6 months. This lasts for 14, right? But boy, it seems to me the odds of that happening are not great. And I don't see a need to go for longer terms. You don't get much of a bump here. Of course, if the Fed projections are right and they get inflation under control, whatever, 344 for 3 years could end up being a great deal a year and a half from now. There's no way to, as far as I'm concerned, there's no way to know. But I still think these, I'm kind of focused on the 6-month. I think is a pretty good deal. Plus, you don't pay state and local income tax. So. All right. Does the 4% rule only work over 50 for people, I guess, for people over 50? So the 4% rule assumes a 30-year retirement. As you get longer, at least to a point, the safe withdrawal rate goes down. Eventually, it kind of flattens out and doesn't, it doesn't get worse. It doesn't get lower at a point. And I think if you're down around 3.5%, it's probably good for just about any length of time. I'm actually doing more research on that very topic, and we'll have more, content for you guys over the next few months. But yeah, the 4% rule, and this was clear in Bingen's paper in 1994, it assumes a 30-year retirement. So. All right. Oh, yes. Mr. Comment. Posting, well, third time's a charm. So my portfolio is, in terms of stock bond allocation, it's roughly 75-25 right now. It fluctuates a little bit. I don't get too concerned about some fluctuation just from natural market changes. I have your pretty standard allocation, U.S. stocks, and then I have small cap. I have a little tilt towards value through the Schwab fund, but it's very small. And then I have international, just your standard one fund that covers developed and emerging market. In the past, I've owned REITs. I don't now, just trying to simplify. And then on the bond front, it's basically a B&D kind of bond exposure for the most part. But I also own some I bonds, and I own those Treasury bills, although I don't include the Treasury bills in my allocation because it's money that we're going to spend in the next year. I do have a small portion in Betterment. That's all our credit card rewards I put over there just to keep it separate. And I will have an update for you guys on that. Folks have been asking me about that and what cards I use or would recommend. So I'll probably have that for you in September. What else? I think that's it. No. So all of the funds are index funds, but I do own 5 stocks, and they account for roughly 20% of our portfolio. I own Apple, which is by far the single largest position. I own Berkshire, Bank of America, Wells Fargo, and Deere and Company. Very small position in Deere. Yeah, that's my portfolio. I don't think I'm missing anything. Okay. So from Cold War 81. Hi, Rob. What do you think about risk assets like cryptocurrencies in the short term? So I don't own any crypto. I'm not a fan of it because it has nothing to do with like the future of blockchain. Folks have like criticized Warren Buffett and Charlie Munger for saying that Bitcoin or crypto is rat poison. I think that's what they said. I'm not really sure. They need to be more direct. I'm not quite sure how they feel about it. Because some claim that they don't understand blockchain. Well, first of all, I'm not sure I would assume that they don't understand blockchain, but maybe they don't. But I think one of their responses would be, we don't need to understand blockchain. If we were evaluating a business that's making money from technology it's developed using blockchain, then we might need to know that. That's not Bitcoin, right? Bitcoin doesn't earn anything. It just sits there. I suppose in theory you could lend it out, but that's a kind of different kind of thing. And that's kind of been my view. I just don't think it has. It will go up and down in value, and you might time it. And obviously, there have been people that have become billionaires because they timed it right. They got lucky, and Bitcoin, I don't mean to minimize. Maybe they had the foresight to know that it was just going to go up in value, and they were right, and so they made a lot of money. But I don't think that makes it a good investment. People, can make a lot of money in the lottery. I don't think it makes it a good investment. If you talk to a lottery winner, you're never going to convince them that playing the lottery was not a smart move. It was not a good investment because they won. Okay, I ain't got no problem with that. But I just don't think it's a smart investment. I think of Michael Saylor a lot. I don't know why. He really rubs me the wrong way. He's the founder and CEO of MicroStrategy, and he basically has bet his entire company on Bitcoin. And they're in a huge loss right now. I think Bitcoin's trading at around 20 grand, right? Yeah, 20,300. And so they've lost like, I don't know, $1 billion. But there's a bigger issue there. And it's that he started buying it, whatever, a couple of years ago. And think about the first tranche of Bitcoin he bought. Bought it. Today, what's he have? The exact same thing he bought 2 years ago. Nothing's changed about that Bitcoin. It's sitting there. It's worth less at the moment. Maybe it'll go up. The point being, you can take a company that maybe has gone down in value for whatever reason. Stock market's gone down, interest rates are going up. But if it's continuing to do well, it's not the same thing that it was 2 years ago. Its balance sheet is different now. Hopefully for the better. It's changed. You're actually investing in something that is generating a product or service, generating revenue, hopefully making a profit, reinvesting that money, at least some of it, back into the company, and it's growing. The Apple stock I own today, what that represents looks totally different than what it represented when I first bought it almost 10 years ago. I suppose you could say I still own X number of shares of Apple, but those shares represent something different than they did, very different, as a matter of fact, than they did 10 years ago. I could own Bitcoin for 100 years. It won't represent anything other than one Bitcoin. Just like I could buy a barrel of oil and stick it in the garage. And 100 years from now, I'd have a barrel of oil. Anyway, that's my take on crypto. All right. What do we have? I'm just going to scroll quickly through here looking for. TC wants to know if I know of any investment clubs in Northern Virginia area. I don't, actually. I've never been a part of one. They kind of sound like fun. I don't know. You want to start one? We can meet at a Starbucks. My typing is very aggressive. I learned to type from Mrs. Jones in the 9th grade. Of course, we had mechanical typewriters. And I was the fastest typer in the class. And yes, I'm bragging a little bit. But it was my only B in high school. No, I think it was one of two. I got and I got the B because we were supposed to bring in a dictionary, part of the class, and I always forgot, and she marked down points. Very sad. Anyway, At one point, I made some offhand, I didn't think I was offending her. I just said, it's funny, I'm taking this typing class, but I'm never going to need to type. And she got so angry. I was like, I didn't realize I had offended her. And she hollered at me. And then, of course, computers. And so I type every day. Yeah, it's very aggressive. How I roll. Okay. What do we have? Okay, CC. What does CC have to say? I've been using the portfolio visualizer and enjoy it a lot. When I enter in Takeda Pharma, though, it shows something like a 1,800% increase in value. Is that an error? I don't know. I don't even know what that is. What's the ticker? TAK. All right, well, let's figure this out. Oh, I bet you I know what this is. You can get a weird compound annual growth rate, particularly if you dollar cost average into it. It gets all wonky. Yeah, so here it is. And this goes from 01 to 2022. And you can see, oh boy, look at 2010 was big. What happened there? I have no idea. Seems weird. Well, that might be your answer right there. I don't know what that was. Well, maybe it was a big increase. I don't know what happened in 2010. That might be your answer right there. So I don't know if that's a data error or not. Did something happen in 2010 with this pharmaceutical company? That's the question. So Jeff's question is, assuming no taxes or fees and assuming two assets with equal expected rate of return, wouldn't it make sense to constantly be rebalancing between them, selling and the high and buying the low? Well, Jeff, there are studies, which I cannot put my hands on right at this moment, that actually suggest rebalancing too frequently is not ideal, because the momentum is, and I'm not a momentum investor per se at all, but that momentum can influence, is a real factor, and that, say, rebalancing monthly, for example, could actually hurt. And in fact, can we model that? Let's do that. Let's just see. Let's imagine we're going to do, we'll do SPY, which is S&P 500, 50%, and we'll do BND, 50%. And we will, let's put in $1 million. Let's think big. And we're going to rebalance annually. How much data do we get? So this is good. This is 14 years. And we end up with 2.576, right? Well, we'll just use this. That's all that really matters. 6.7 compound annual growth rate. What happens if we rebalance monthly? So again, we're comparing that to 6. By the way, this is not exactly, let me take the comment down. This is not exactly a scientific experiment, but hey, whatever. So we're 6.7. Will it be lower? Yeah, it's a little bit lower, 6.51. Not huge, but again, I'm not sure how scientific that is, but I have read studies that suggest you can rebalance too frequently. One approach would be opportunistic rebalancing, and there's a video that I did that describes it. There's a paper you can check out. Okay. Oh, wait a minute. We have an econ major in the house, Ralph. Econ major here. If I recall correctly from college, inflation is always and everywhere a case of too much money chasing too few goods. Okay. I can't argue with an econ major. There can be, though, inflation can be caused because of the demand side, right? Or the supply side. And that's an important distinction as I understand it. And if you think about demand, the demand side for a second, let's just say demand for some product goes sky high. And so people want it, and the company has to start ramping up, but prices have gone up because they haven't been able to match the demand yet, but they're trying, right? Obviously, a company's going to have it in their interest to do that. So what are they doing? They're hiring. We need people to make these widgets to fill the demand. And so you can have inflation in this, and again, I'm using a very specific product as an example, but you could have inflation and with low unemployment, right? Because they're actually hiring people. Or you could have a company where demand hasn't changed at all. They're not able to produce the product because they can't get chips from, I don't mean potato chips, processors. They can't get what they need from their suppliers to put in cars to make them. And so they kind of ground to a halt. And in fact, that can actually create higher unemployment because they lay people off. We're waiting for supply. We don't have anything to build right now. And there's this thing called the Phillips curve, which sort of talks about the relationship between employment, inflation. There's a St. Louis Fed article, which I'll show you, and you can check out at your leisure on this whole thing. And the Phillips curve, that's actually a big part of Bernanke's book. And the point being that, we thought we understood things. Turns out we don't. And, there's this question, is the Phillips curve dead? Nah, it's mostly dead, but it's still breathing a bit. Anyway. What else do we have? Omar, it's my pleasure. I mean, it's a tough job, but someone's got to do it. I really do recommend, if you're interested at all, this book. I mean, it was very easy to understand. It's funny, there's a section at the end, the last section, the first 80% of the book or whatever is like history. And then there's a section here at the end, like what's the future? And that was the section I was really looking forward to, but it was my least favorite part of the book. It was too academic in a way that I just, I think if you work at the Fed or you study this stuff in great detail, it may be quite useful to you. But I found the history more interesting. Okay. So Kyle wants to know if I own any gold or gold-related stocks. Well, I do not own any gold. And if I don't own any gold-related stocks. I mean, in the index funds, I'm sure I have some mining companies in there, but other than that, no. Again, it's not unlike my view of crypto. I just don't want a non-productive asset, and gold has not been a particularly great hedge to inflation. Certainly not, given if I were to ever buy some, the limited amount I would buy. So I did I tell you the silver story? I think I told you this. So at one point I owned a couple of bars of silver. It's a couple $1,000s worth. And for some reason, I don't remember why, they were under the front seat of my car. Now, I will assure you, I don't keep gold or silver bullion under my car seat. And this was 30 plus years ago. And I'm cruising down, I was in a Cutlass Supreme. It was a great car. And I'm cruising down the New Jersey Turnpike at like 70 miles an hour, along with every other car in New Jersey. And a cop sees me, he's sitting in the middle, and we make eye contact, which is never a good thing. Sure enough, he pulls me over. I think he thought I was running drugs. He came up, cars are zipping by us on the side of the road. License, registration. What do you have under your front seat? That was his question. I guess that's where the drug runners keep all their drugs. I don't know. And I'm thinking, what do I have under the front? I'm thinking, and then I remembered. I have 3 bars of silver. just looked at me. And he asked if he could look. I said, sure. He gets on his hands and knees on the New Jersey Turnpike with cars flying by. Yeah, 3 bars of silver, which was not illegal. He gave me a warning. Okay. By the way, I'm in the middle of Pilates, not as I speak, but been taking Pilates twice a week, tumbling. It surprises me that it seems to me anyway, that Pilates is mainly dominated by women, that not a lot of men, at least that I've ever seen, take Pilates. And I got to tell you, it's one of the hardest things I've ever done. And I'm still doing the basic stuff. I haven't gotten to whatever fancy stuff they do. So Jeff wants to know what I think of Schwab or Fidelity as an alternative or addition to Vanguard. So I like them both. I probably, if I had to only have one, I would probably pick Fidelity. I just like their technology, their website, their customer service, their features, the cash management. Yeah, that would be my choice. All right. So Doug wants to know the dates and times of the live show. So this show is every Monday at 7 p.m. Although next week, Labor Day, I will not be doing a show, but the following week, Lord willing, and the creek don't rise, I will. So where you can find this, I think, let me just see. So that's a good question. So I'm looking at my channel. I hope you probably can't see that very well. So this is the show right now that's live. I've got another one in here that I thought, let me see. If I can figure this out. Okay, here we go. So I think if you go to videos, whoops, and then you go uploads, I think you see this. Upcoming live streams. I'm logged in as me, so I don't know. I think anyone can see this. This is the one with Ben Miller, who's the CEO of Fundrise for Wednesday. The Monday shows, I don't normally put up there until Monday, but they're every Monday at 7 p.m. Dark. 3 seasons, okay. Thank you. I need TV recommendations. I just watched the first episode of, what's the name of it? Is it She-Hulk? She-Hulk Attorney at Law. I don't know. I kind of found it amusing. I finished Better Call Saul. This is not a plot spoiler, but it is a casting spoiler. But I was thrilled to see Carol Burnett in that show. That was a lot of fun. One of the best shows ever. Tim Conway, I mean, laugh out loud funny. Wow. Anyway, the whole dentist thing with Harvey Korman, that was just hysterical. I can watch it all day long. Oh, okay. Let's back to money. So Vape King, yes, SoFi and Wealthfront are offering 2% interest on savings. SoFi has it on checking, so true. Those seem to be decent offers. You can do better on savings, but not by a lot. I think you can get about 2.5 now. Let's see what I've got on my site. I have a team now that's been graded. Yeah, 2.5, at least it's one of them. Actually, that's one offered by Save Better. That's 2.5. There could be some that are slightly higher. Anyway, okay. What a great question, Marco. Is it wise to invest in index funds when you know a recession is around the corner? That feels like you're putting money into a stock you know is going down. So the reason I continue to invest and don't take anything out is because it's very difficult to know when that's going to happen, what that's going to look like, how long it's going to last. So if you're trying to time the market, you've got to figure out when to get in and when to get out and when to get back in over and over and over again. Like for, your investing career, right? Or career is the wrong word, your journey as an investor. And I have found that it's incredibly difficult to do that. And that doesn't even account for taxes and probably not fees so much today, but certainly taxes in a taxable account. What I prefer to look at is, and to think about is, what will this look like 10 years from now or 20 years from now? That's what I really care about. Now, not everyone has that view. I was talking to some folks at one large broker, and they absolutely think you should figure out where we are in the business cycle and invest accordingly. I have a good friend who trades options, is into crypto, and he gets in and out of the market in big ways. I've just never found that to be for me, a sustainable way to invest. And I will even go so far as to say, I think I owe, to the extent I've had any success as an investor, I think I largely owe it to the fact that I leave the investments alone. Okay. This is another great question, and we've talked a lot about international exposure. Jack Bogle was sort of famous for not feeling the need to invest in international stocks directly. And I linked to an article in the newsletter this past week, written by Alan Roth. Let me see if I can find it. 10 things I learned. What was it called? That's not the right one. Well, there's another way to find this. I can go to my newsletter. I do want to show you this article. If I can find it. Here we go. There it is. Here it is. It's on Advisor Perspectives website, which I always dislike because of the ads and stuff. But my mistakes over 20 years in an advisory career. International stocks should do as well as U.S. stocks. He talks about Jack Bogle and his view on that. I am too nervous to put all of my eggs in one U.S. basket, as good as that basket is. I don't have a huge exposure to international stocks directly. Of course, the argument that you don't need international exposure is that U.S. companies do business all over the world, right? Microsoft, Apple, Exxon. And so you get that exposure, but still, I'm just not comfortable. You have to do what you're comfortable with. Okay. Huh. I would be happy to turn on closed caption if I know how. Let me see if I can do it right now. Probably not. I'll have to ask for Noreen's help because she's good at all that sort of thing, but I will definitely look into that. All right, scrolling, looking for questions. That's the best comment tonight. OH. You know, we play Notre Dame right out of the gate. That's going to be dicey. I prefer a warm up like against Toledo or something. Akron, I don't know. I have not, I have never done a Roth conversion. I just am not in a position where it makes sense. But the Roth conversion ladder that I am familiar with, let me see if I can also find you a good article. Yeah, I like the guys at Choose FI, so you might check them out. This came up on the first page of Google. I haven't read this article, but they do good work. My understanding of it, the way they work, is so when you do a conversion, you've got that 5-year rule, right? And there's actually 2 5-year rules with Roth IRAs, but we're talking specifically about conversions. And so you could do a conversion every year so that 5 years later, if you meet all the other rules, you'll have access to that money. So like early retirees who might have, say, taxable investments they can live off on, some savings, maybe they're still working part-time, but they'll start to do Roth conversions where, for starters, their tax rates are low if they're not working full-time. Maybe they retired early, for example. I'm not saying this is the only situation where it might make sense, but this is the one that where I often hear it most frequently described. And so you'll start to get that, after 5 years, your first conversion is now available. And then again, if you meet all the rules, and then after year 2, your second one is available and so on. And so you get that ladder effect. You know who else did a good article on this? Is the Mad Scientist. So right here, how to access retirement funds early. This is, as I recall, I don't know if he's kept this up to date or not. Oh yeah, well, updated in February. A very thoughtful piece with a lot of detail. So you can check that out. All right. Well, so the question is gold a good idea to hedge inflation? And I've heard very mixed results. I mean, certainly not this year, right? I mean, what's gold done this year? Gold returns 2022. What is it? I love how people predict the price of gold. Let's do a gold ETF. That'll be the easier way to do it. Isn't there one just like GLD or something? Yeah, GLD. All right. Buy gold shares. So inflation is raging. Oops, not what I wanted. And it's lost 5% this year. Now, in fairness, one could argue that, yeah, it's not a perfect inflation hedge, but over a number of years, maybe it is. But the research I have read on this issue, and I can't point to it. I should be able to. If my note-taking system was better. It says it's not really a great hedge. The other thing is a more practical consideration. How much would you have to put into gold? What percentage of your portfolio? So that even if it were a hedge, it would have a meaningful difference. Are you going to put 20% of your, I guess, Dalio, I think, recommended something like that in his 25% in each category for his all weather. But, I certainly could never see myself doing that. So that's my view. Whoops. All right. Well, space travel 1776. We've talked about this in past videos. I think a Vanguard money market could be fine. VGSH. Let's take a look. See, I still like Treasury bills, but It's a short-term Treasury ETF. That would be a perfectly good option. Got an SEC yield of 319. That's pretty good. What's its duration? So it does have a duration of just under 2 years. You could lose a little money in this in the short term, right? I mean, again, the interest rate risk is limited. That's why it's the colored box is in this first column, and its investment quality is, of course, high. It's the Treasury, I guess, notes primarily. We can actually look. I think they're all 1 to 3 year. That'd be a Treasury note, right? Well, I guess in theory they could have bonds that they bought long after they were issued, right? Anyway, no, they're all notes. At least the top 10 notes, 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 notes. I don't know what I'm saying anymore. I mean, I think those are reasonable options. So G wants to know why the total bond market funds do not also contain TIPS. I knew the answer to that at one point. They don't. They track they track an aggregate bond fund that or index that doesn't include certain types of bonds, among them inflation-linked bonds. There's a I don't remember the details of why, but I have something for you. Rick Ferry does a Boglehead podcast. I was on it not that long ago, but here it is. There's Rick. I'll see Rick at the Boglehead conference. Oh, there I am. Guest Rob Berger. Anyway, the one I wanted to show you was, I think it's this one. Let's see. Yeah, this is a great interview of on bond investing and bond funds, and they talk about the fact that I'm pretty sure that TIPS are not included in like a B&D and sort of some of the rationale behind that. So you could check that out if you want to know more. Our time is almost up. So Iggy, normally if, you know, particularly if you're still accumulating, you're not anywhere near retirement. If you're buying sort of low-cost index funds in a well-diversified portfolio, you actually want the market to crash because you'll be buying at cheaper and cheaper and cheaper prices. So if you're an accumulator, you're still contributing to your whatever 401k, IRA, or taxable accounts. You know, a bear market is your friend. It may not feel good. Now, if you're buying, as you said here, speculative stocks, that's a whole different ballgame. All right. So Kyle, I've talked about funds like this, and I'm not a fan. But I'll mention it again and add it to my notes so that I know that I talked about it tonight. And I am wrong because this is not the fund I thought it was. See, this is why I need to take notes. This is a JP Morgan Equity Premium Income Fund. I was thinking it was something else. I don't know a thing about this fund, but I will look into it. %15% is not classified. What's up with that? Yeah, I'll have to look into it. I don't know enough about it. I guess I don't know. So this is a question from Malay. I don't know what you mean by to properly sell treasuries before maturity. I mean, you can obviously sell them. There's a, a deep market for treasuries. And through your broker, presumably, right? I could go in and I could sell the treasury bills that I bought. If you think about a treasury bill, they're zero coupon bonds, right? So you buy them. If it's $1,000 face amount, you might pay whatever, $980. I'm just making a number up. You'll pay something less than $1,000, and as you near maturity, that price, that value goes up and up and up and up and up. It can also change based on interest rates, but again, these bills are so short term, interest rates aren't going to affect them like they would, say, a 30-year bond. But eventually, on the date they mature, they're worth $1,000. But you can sell anytime. So I guess I don't know. I guess I need to understand your question better. I will tell you, when I bought them, my last bit, I clicked the buy button. After they give you a chance to review it. So I looked at it. Yeah, that's what I want. Buy. The screen, refreshed instantly, and there was a link for order status, and I immediately clicked order status. So I mean, maybe 2 seconds went by, and the order was filled. Of course, it's Treasury, so that's just the market, and I'm probably actually buying them from Schwab. I wouldn't surprise me. I don't know, but in any event, it filled immediately. Well, our time is up. And it goes by fast. Well, for me, it does. You guys might be thinking, man, this thing is dragged on. Noreen is taking a cheap shot at me. Yes, Noreen, I was wrong about the typing. Yeah. Mrs. Jones, if you're watching, I'm sorry. I meant no offense by my comment. Still don't understand the B. I was the fastest typer in the class. Just saying. Maybe. Okay, whatever. I'm just scrolling through here for more questions, even though the time is up. Well, Jeff, what is the game of retirement? What does that mean? It is tricky. It's a lot trickier dealing with your money and investments in retirement. It's I don't know, 5 times harder, 3 times harder than just accumulating, particularly in looking back on it, was easy. Yeah, there are times when the market's down, you're nervous or whatever, but retiring is, from a financial perspective, there's just a lot more moving parts, a lot more issues. Okay, so there's some back and forth on inflation. That's all good. Leon, I think VXUS is a really good fund to get exposure to international stocks. I don't know what you mean by distributed effectively with markets. I mean, it includes developed and emerging markets. I guess I should just double check to make sure, but I know that it does. And we can see that on Morningstar. So this is the fund. I went to portfolio. I come down here to sector. This is just exposure. And if I go to region, and yeah, so most emerging markets are in Asia. There's some Eastern, I guess. There's some minor Europe emerging. Most of it's in Asia, and that's 15%. So yeah, I think it's a good fund. No, I think you guys are just making fun of me now. I guess Michael keeps some of his gold in his glove box. I hope that's not true. So I do get pulled over. I've had 3 tickets in my life, 2 speeding tickets. The last one was, I don't know, 15 or 20 years ago. Oh, the Cutlass Supreme was a work of art. There's no question about it. But it definitely had that vibe that said to police, pull me over. I like that car. Hang on. This is important. You don't put pineapple on pizza. I'm sorry. That's just wrong. Oh, that's right, Noreen. They voted for the Pilates video. No, I thought it was me pulling a sled. Yeah, you definitely don't, which I didn't do. I haven't pulled the sled this week. All right. Well, I have to call it a night. So next week, there will not be a show. But this Wednesday, again, I'm interviewing the CEO of Fundrise. If you have any questions there, I'm looking forward to that. I have a lot of questions because basically I don't really know how Fundrise works. And I thought I could do all the work myself and figure it out and give you my views on it. But why not just bring them on and let them tell us? It's easier for me. I can just ask some questions. So email me those questions. If you haven't signed up for the newsletter, you can do that below the video. It goes out every Sunday. And I think that's all I got. Yeah. Well, have a great week. And until next time, remember, the best thing money can buy is financial